Introduction to International Real Estate. International real estate investment involves acquiring property assets outside of an investor's home country. This strategy offers unique opportunities for portfolio diversification and potentially higher returns compared to domestic markets. Investors often seek to capitalize on different economic cycles, demographic trends, and regulatory environments across various nations. Understanding the global landscape is crucial for making informed decisions and mitigating inherent risks. This course will guide you through the complexities, helping you build a robust framework for successful international real estate ventures. It emphasizes the importance of thorough preparation and strategic execution in a diverse global market. Embracing a global perspective can unlock significant value. The motivations for international real estate investment are varied, ranging from capital appreciation and rental income to hedging against domestic market volatility. Some investors are drawn to emerging markets for their rapid growth potential, while others prefer the stability and established legal frameworks of developed economies. Each region presents its own set of advantages and challenges, requiring a tailored approach to research and due diligence. Successful international investors often possess a keen awareness of geopolitical factors and cultural nuances that can impact property values and investment outcomes. This introductory module sets the stage for a deeper exploration of these critical elements. Why invest internationally? Benefits and risks. Investing in international real estate offers several compelling benefits. Primarily diversification. By spreading investments across different geographical regions, investors can reduce their exposure to the economic downturns or market-specific risks of a single country. This diversification can lead to a more stable and resilient investment portfolio over time. Additionally, international markets may offer higher growth potential or more attractive yields compared to an investor's domestic market, especially in rapidly developing economies. Access to new asset classes and unique investment opportunities not available locally can further enhance portfolio performance. Currency fluctuations can also present opportunities for additional gains, though they also introduce risk. Ultimately, it provides a broader playing field for capital deployment. Despite the attractive benefits, international real estate investment comes with inherent risks that demand careful consideration. Currency exchange rate volatility can significantly impact returns, as fluctuations can erode profits or amplify losses when converting foreign earnings back to the home currency. Political instability, changes in government policies, and regulatory shifts in foreign countries pose substantial risks to property rights and investment security. Legal complexities, including differing property laws, taxation rules, and inheritance regulations, can complicate transactions and ownership. Furthermore, cultural differences and language barriers can hinder effective communication and due diligence, making local expertise indispensable. Understanding and mitigating these risks is paramount for successful international ventures. Understanding global real estate markets. Global real estate markets are incredibly diverse, influenced by a myriad of factors including economic growth, interest rates, population demographics, and government policies. Developed markets, such as those in North America and Western Europe, often offer stability, mature legal systems, and predictable returns, though growth might be slower. Emerging markets in Asia, Africa, and Latin America, conversely, can present higher growth potential due to rapid urbanization and economic development, but often come with increased volatility and regulatory uncertainties. Each market segment, whether residential, commercial, industrial, or hospitality, responds differently to these overarching influences. A deep understanding of these regional and sectoral dynamics is essential for strategic investment. Analyzing these differences helps investors align their goals with suitable market conditions. This nuanced approach is key to success. Key indicators for assessing global real estate markets include GDP growth, inflation rates, employment figures, and housing affordability indices. These economic metrics provide insights into the health and trajectory of a country's real estate sector. Furthermore, understanding local supply and demand dynamics, vacancy rates, and rental yields is crucial for evaluating specific property types. Geopolitical stability, ease of doing business, and the strength of property rights protections also play a significant role in attracting or deterring international investors. Cultural factors, such as preferences for certain architectural styles or community layouts, can also influence market demand. Comprehensive analysis of these diverse elements allows for informed decision-making. Key factors influencing international markets. Several critical factors profoundly influence the performance and attractiveness of international real estate markets. Economic stability and growth are paramount, as strong GDP growth typically correlates with increased demand for both residential and commercial properties. Interest rates play a significant role, affecting borrowing costs and investor returns, with lower rates generally stimulating investment. Demographic shifts, such as population growth, urbanization, and changing household structures, drive demand for specific property types in different regions. Government policies, including zoning laws, foreign ownership restrictions, and investment incentives, can either facilitate or impede international investment. Understanding these macro-level forces is fundamental to identifying viable opportunities and assessing potential risks. Geopolitical stability is also a crucial consideration. Technological advancements are increasingly shaping international real estate, from prop-tech innovations streamlining transactions to data analytics providing deeper market insights. Infrastructure development, including transportation networks, utilities, and digital connectivity, enhances property values and accessibility, making regions more attractive for investment. Environmental, social, and governance (ESG) factors are also gaining prominence. With a growing demand for sustainable and ethically managed properties, investors must consider the long-term implications of climate change and resource scarcity on property values and operational costs. Local market liquidity, or the ease with which properties can be bought and sold, is another vital factor influencing investment decisions. These diverse elements collectively determine market dynamics. Identifying promising international real estate markets requires a systematic approach, combining macroeconomic analysis with micro-level market intelligence. Begin by evaluating countries with strong economic fundamentals, including consistent GDP growth, low unemployment, and a stable political environment. Look for regions experiencing favorable demographic trends, such as a growing middle class, increasing urbanization, or a young junction, expanding workforce. These factors often drive demand for both residential and commercial properties. Consider countries with transparent legal systems and robust property rights protections, which reduce investment risk. Emerging markets with significant infrastructure development plans can also offer substantial long-term growth potential. Thorough research into these areas is paramount. Once a list of potential countries is established, narrow down the focus to specific cities or regions within those countries that exhibit strong local market indicators. Analyze factors like population density, income levels, job growth, and infrastructure projects within these specific areas. Research local supply and demand dynamics, including vacancy rates, rental yields, and property price trends for different asset classes. Engage with local real estate professionals, market analysts, and government agencies to gain nuanced insights and verify data. Look for areas with diverse economies that are not overly reliant on a single industry, as this can provide greater resilience. This multi-layered approach helps pinpoint the most attractive investment opportunities. Economic indicators and political stability. Economic indicators are crucial for assessing the health and future prospects of an international real estate market. Key metrics include gross domestic product, GDP growth, which signifies overall economic expansion and often correlates with increased demand for property. Inflation rates impact the purchasing power of currency and the cost of goods, influencing real estate values and rental income. Unemployment rates provide insight into labor market strength, directly affecting housing demand and consumer spending. Interest rates determine borrowing costs for mortgages and development loans, significantly influencing investment viability. A thorough analysis of these indicators helps investors gauge market momentum and potential returns. Understanding these trends is vital for long-term planning. Political stability is equally paramount, as it directly impacts the security of investments and the predictability of the regulatory environment. Countries with stable governments, strong rule of law, and low corruption levels generally offer a safer investment climate. Conversely, regions experiencing political unrest, frequent changes in leadership, or geopolitical tensions present higher risks to property rights and investment returns. Government policies related to foreign ownership, taxation, and urban development can also significantly influence market attractiveness. Investors must research a country's political history, current governance structure, and potential for future stability. Engaging with local experts can provide invaluable insights into the political landscape and its potential impact on real estate investments. This due diligence is non-negotiable. Legal and regulatory frameworks. Navigating the legal and regulatory frameworks of international real estate markets is one of the most complex aspects of cross-border investment. Each country possesses its own unique set of property laws, including those governing ownership rights, land registration, and transfer procedures. Foreign ownership restrictions can vary significantly, ranging from outright prohibitions to specific limitations on property types or investment amounts. Understanding these nuances is critical to avoiding legal pitfalls and ensuring the legality of an investment. It is imperative to engage with local legal counsel who specializes in real estate and international law to conduct thorough due diligence. This expert guidance helps in interpreting complex regulations and ensuring compliance. Ignoring these frameworks can lead to significant financial losses and legal disputes. Beyond ownership laws, investors must also contend with local zoning regulations, building codes, environmental protection laws, and landlord-tenant statutes. These regulations dictate how a property can be used, developed, and managed, directly impacting its potential value and operational costs. For instance, strict environmental laws might impose additional compliance costs, while favorable zoning could unlock development opportunities. Furthermore, understanding the process for dispute resolution and contract enforcement in a foreign jurisdiction is crucial. The legal system's efficiency and fairness can significantly influence an investor's ability to protect their assets and enforce agreements. Comprehensive legal due diligence is not merely a formality, but a cornerstone of successful international real estate investment. Taxation and repatriation of funds. International real estate investment is significantly impacted by the tax regimes of both the host country and the investor's home country. Investors must understand various taxes, including property taxes, capital gains taxes on sale, rental income taxes, and inheritance taxes. Double taxation treaties between countries can help mitigate the burden of being taxed on the same income or capital in two jurisdictions. However, the specifics of these treaties vary, and their application can be complex. Engaging with international tax advisors is essential to structure investments in a tax-efficient manner and ensure compliance with all relevant laws. Failure to plan for tax implications can severely erode investment returns. This planning is a critical component of due diligence. Repatriation of funds, or the process of bringing profits and capital back to the investor's home country, is another crucial consideration. Some countries impose restrictions or taxes on the outward transfer of funds, which can affect liquidity and overall returns. These restrictions might include limits on the amount of capital that can be repatriated, specific approval processes, or additional withholding taxes. Currency controls and exchange rate fluctuations also play a significant role in the actual value of repatriated funds. Investors need to thoroughly investigate a country's foreign exchange regulations and capital control policies before committing to an investment. A clear understanding of these processes is vital for managing cash flow and realizing expected profits. Proper planning ensures smooth capital movement. Direct versus indirect investment. International real estate investment can be approached through two primary methods: direct and indirect investment. Direct investment involves the outright purchase of physical property, such as a residential apartment, a commercial building, or undeveloped land. This method provides investors with full control over the asset, allowing for direct management, renovation, and leasing decisions. While offering greater autonomy and potentially higher returns, direct investment also requires significant capital, extensive due diligence, and a deep understanding of local market conditions and regulations. It often entails higher transaction costs and can be less liquid, making it suitable for long-term investors willing to actively manage their assets. This hands-on approach demands considerable commitment. Indirect investment, conversely, involves investing in real estate-related securities or funds rather than directly owning physical property. Common indirect vehicles include real estate investment trusts, REITs, real estate mutual funds, and private equity real estate funds. These options offer greater liquidity, lower capital requirements, and professional management, making them accessible to a broader range of investors. REITs, for example, trade on stock exchanges, providing easy entry and exit points, while indirect investments offer diversification and reduced operational burdens. Investors have less control over individual assets and are subject to market fluctuations of the underlying securities. The choice between direct and indirect depends on an investor's capital, risk tolerance, and desired level of involvement. Residential real estate opportunities. International residential real estate offers a wide array of investment opportunities, ranging from single-family homes and apartments to multi-unit dwellings and vacation rentals. Factors driving demand in residential markets include population growth, urbanization, rising disposable incomes, and favorable mortgage rates. Investors often target cities with strong job markets, reputable educational institutions, and attractive lifestyle amenities, as these areas tend to experience consistent rental demand and property value appreciation. Emerging markets, in particular, can offer significant growth potential due to rapid urbanization and an expanding middle class seeking improved housing. Understanding local housing preferences and cultural norms is crucial for successful residential investments. This market segment can provide stable rental income. Investing in residential properties abroad can also serve personal goals, such as acquiring a vacation home or a retirement property. However, even these personal investments should be evaluated through an investment lens, considering potential rental income, property appreciation, and resale value. Challenges include managing properties remotely, dealing with diverse landlord-tenant laws, and understanding local market cycles. The rise of short-term rental platforms has opened new avenues for income generation, but also introduces regulatory complexities and increased competition. Thorough market research, coupled with reliable local property management, is essential for maximizing returns and minimizing operational headaches in international residential real estate. Careful planning is key to success. Commercial real estate opportunities. International commercial real estate, CRE, encompasses a broad spectrum of property types, including office buildings, retail spaces, industrial warehouses, and hospitality assets like hotels. Investment in CRE is often driven by economic growth, business expansion, and consumer spending patterns. Key considerations for CRE investors include lease terms, tenant quality, vacancy rates, and the overall economic outlook for the specific sector and region. Office markets thrive in cities with strong corporate presence and skilled workforces, while retail depends on consumer foot traffic and purchasing power. Industrial properties benefit from e-commerce growth and robust supply chains. Each sector presents unique risk-reward profiles. Understanding these dynamics is crucial. Investing in international CRE typically involves larger capital outlays and more complex transactions than residential properties. Due diligence must extend to evaluating the creditworthiness of tenants, the stability of long-term leases, and the potential for market shifts impacting demand. The hospitality sector, for instance, is highly sensitive to tourism trends and global travel patterns. Industrial real estate, conversely, has seen significant growth driven by logistics and e-commerce, making well-located warehouses and distribution centers attractive. Investors often seek properties in strategic locations with strong infrastructure and access to major transportation hubs. Partnering with experienced local CRE brokers and property managers is essential for navigating these specialized markets and maximizing returns. This collaboration mitigates many operational challenges. Diversification strategies. Diversification is a cornerstone of prudent international real estate investment, aiming to reduce overall portfolio risk while enhancing potential returns. A common strategy is geographical diversification, spreading investments across multiple countries or regions with different economic cycles and market drivers. This approach minimizes exposure to a downturn in any single market. Investors can also diversify by property type, allocating capital across residential, commercial, industrial, and hospitality sectors. Each property type responds differently to economic conditions, providing a natural hedge. For example, industrial properties might perform well during e-commerce booms, while office spaces could thrive in growing business hubs. This multifaceted approach builds resilience. Further diversification can be achieved through varying investment strategies, such as core, value-add, and opportunistic approaches. Core investments typically involve stable, income-generating properties in prime locations with low risk. Value-add strategies focus on improving existing properties to increase their value and rental income. Opportunistic investments target distressed assets or development projects with higher risk, but also higher potential returns. Combining these strategies can create a balanced risk-reward profile. Additionally, diversifying by investment vehicle, utilizing both direct property ownership and indirect methods like REITs, can enhance liquidity and access to different market segments. A well-diversified international real estate portfolio is designed to withstand market volatility and achieve long-term growth. This comprehensive strategy is key. Financing international real estate. Financing international real estate investments can be more complex than domestic transactions, requiring a thorough understanding of local lending practices and currency considerations. Investors typically have several options, including obtaining a mortgage from a local bank in the host country, using international lenders, or leveraging equity from their home country. Local financing can often provide more favorable interest rates and terms, as local banks are familiar with the market and property values. However, it may require establishing a local presence or meeting specific residency requirements. International lenders, while offering cross-border solutions, might have higher interest rates or more stringent collateral requirements. Careful comparison of these options is crucial. Beyond traditional mortgages, investors can explore alternative financing methods such as private equity partnerships, joint ventures with local developers, or seller financing. Private equity funds specialize in real estate investments and can provide significant capital, often in exchange for a share of ownership or profits. Joint ventures allow investors to pool resources and expertise with local partners, mitigating some of the risks associated with foreign markets. Seller financing, though less common, can offer flexible terms directly from the property owner. The choice of financing strategy depends on the investor's capital availability, risk tolerance, and the specific nature of the investment. Understanding the implications of currency exchange rates on loan repayments is also paramount. Strategic financing is a key to success. Currency exchange rate risks. Currency exchange rate fluctuations represent a significant risk in international real estate investment, potentially impacting both initial capital outlay and future returns. When an investor purchases property in a foreign currency, a weakening of their home currency relative to the foreign currency before the transaction can increase the effective purchase price. Conversely, If the foreign currency weakens against the home currency after the investment is made, the value of the property and any rental income, when converted back, will be reduced. This risk affects both capital appreciation and income streams. Monitoring global economic news and central bank policies is crucial for anticipating potential currency movements. Understanding these dynamics is vital for protecting investment value. To mitigate currency exchange rate risks, investors can employ several hedging strategies. Forward contracts allow investors to lock in an exchange rate for a future transaction, providing certainty for a specific period. Currency options offer the right, but not the obligation, to exchange currencies at a predetermined rate, providing flexibility. Diversifying investments across multiple currencies can also spread this risk, as not all currencies move in the same direction simultaneously. Structuring debt in the local currency of the investment can create a natural hedge, as both assets and liabilities are exposed to the same currency fluctuations. Consulting with financial experts specializing in foreign exchange is highly recommended to implement effective hedging strategies. Proactive management of currency risk is essential. Political and economic risks are intertwined and can significantly impact international real estate investments. Political instability, such as coups, civil unrest, or sudden changes in government, can lead to widespread uncertainty, property damage, and even expropriation of assets. Changes in government policy, including new foreign ownership restrictions, increased taxation, or altered land use laws, can directly diminish investment value. Geopolitical tensions, trade wars, or international sanctions can also create an unfavorable investment climate, deterring foreign capital. Investors must conduct thorough political risk assessments, often involving expert analysis of a country's governance, legal system, and social cohesion. This proactive approach is essential for safeguarding assets. Economic risks extend beyond currency fluctuations and include recessions, hyperinflation, and sovereign debt crises. A severe economic downturn in a host country can lead to decreased demand for real estate, falling property values, and higher vacancy rates. Hyperinflation can erode the real value of rental income and property appreciation, even if nominal values rise. Sovereign debt crises can trigger capital flight, currency devaluation, and a freeze in lending, severely impacting real estate liquidity and financing availability. Investors should monitor key economic indicators, diversify across different economies, and consider insurance options where available. Understanding the interplay between political decisions and economic outcomes is crucial for navigating these complex international markets effectively. Vigilance is a key attribute for success. Legal and regulatory risks. Legal and regulatory risks in international real estate are diverse and can significantly impact an investment's viability and security. These risks stem from differences in property laws, foreign ownership restrictions, and the enforcement mechanisms of foreign jurisdictions. A country's legal system might be less transparent or efficient than an investor is accustomed to, leading to delays, increased costs, or difficulty in enforcing contracts. Changes in zoning laws, building codes, or environmental regulations can impose unexpected costs or limit a property's potential use. It is crucial to understand the legal framework governing property acquisition, ownership, and disposal in the target country. Engaging local legal counsel is not merely advisable, but essential for navigating these complexities. Furthermore, the risk of expropriation, where a government seizes private property for public use, often with inadequate compensation, is a serious concern in some jurisdictions. While rare in developed markets, it remains a possibility in politically unstable regions. Intellectual property rights related to development projects or unique architectural designs may also be less protected abroad. Understanding the local judicial system, including the efficiency of courts and the impartiality of judges, is vital for assessing dispute resolution risks. Investors should also be aware of anti-money laundering (AML) and anti-corruption laws, as non-compliance can lead to severe penalties. Proactive legal due diligence and ongoing monitoring are critical for mitigating these multifaceted legal and regulatory risks. This vigilance protects assets. Due diligence process deep dive. A comprehensive due diligence process is the bedrock of successful international real estate investment, meticulously examining every aspect of a potential acquisition. This involves a detailed review of the property's legal title, ensuring clear ownership and absence of encumbrances like liens or easements. Financial due diligence scrutinizes income and expense statements, lease agreements, and projected cash flows to verify profitability and identify hidden costs. Technical due diligence assesses the physical condition of the property, including structural integrity, environmental hazards, and compliance with local building codes. Environmental assessments are critical to identify contamination risks or regulatory non-compliance. This multifaceted approach minimizes unforeseen liabilities and risks. Thoroughness at this stage is paramount. Beyond the property itself, due diligence extends to understanding the local market, including supply and demand dynamics, comparable sales, and rental rates. Investors must also evaluate the political and economic stability of the region, as discussed previously, and assess any specific foreign investment restrictions. Engaging a team of local experts, including real estate lawyers, tax advisors, property appraisers, and engineers, is indispensable. These professionals provide invaluable insights into local nuances, regulations, and market conditions that might not be apparent to foreign investors. The due diligence process is iterative and can be time-consuming, but it is a non-negotiable step to validate the investment thesis and protect capital. It is the investor's primary defense against unforeseen problems. Local partners and professional advisors. Engaging reliable local partners and professional advisors is arguably the most critical success factor in international real estate investment. These individuals and firms provide invaluable on-the-ground expertise, helping foreign investors navigate complex local laws, cultural nuances, and market dynamics. Key advisors include local real estate attorneys specializing in property law, tax consultants familiar with international tax treaties, and reputable real estate brokers with extensive market knowledge. Property managers are also essential for day-to-day operations, especially for remote investors. These partners act as your eyes and ears, ensuring compliance and efficient management. Their insights can prevent costly mistakes and unlock opportunities. Building a strong local network is indispensable. The selection process for local partners and advisors should be rigorous. Seek recommendations from trusted sources, conduct thorough background checks, and verify credentials and experience. Look for professionals with a proven track record in assisting foreign investors and a deep understanding of the specific market segment you are targeting. Establish clear communication channels and define roles and responsibilities upfront through formal agreements. A strong relationship built on trust and transparency is paramount. Local partners can also include joint venture partners, developers, or even local government liaisons, depending on the scale and nature of the investment. Their expertise is not just a convenience, but a necessity for mitigating risks and maximizing returns in unfamiliar territories. This strategic collaboration is a competitive advantage. Property management in foreign markets. Effective property management in foreign markets is crucial for preserving asset value and ensuring consistent rental income, especially for investors who are not physically present. This involves a range of responsibilities, including tenant acquisition and screening, lease administration, rent collection, and property maintenance. Local property managers possess an intimate understanding of local landlord-tenant laws, cultural expectations, and market rental rates, which is invaluable for optimizing performance. They handle day-to-day operational issues, respond to tenant inquiries, and coordinate repairs, relieving the investor of these burdens. Selecting a reputable and experienced property management firm is paramount for success. Their expertise ensures smooth operations and tenant satisfaction. When selecting a property manager, Consider their track record, fee structure, communication protocols, and technological capabilities. A good property manager should provide transparent financial reporting, regular property inspections, and proactive maintenance schedules. They should also be proficient in handling legal matters, such as evictions or lease disputes, in accordance with local laws. For remote investors, clear and consistent communication is vital, often facilitated by digital platforms for reporting and updates. Understanding the property manager's scope of services and ensuring it aligns with your investment goals is essential. A well-managed property not only generates stable income, but also maintains its value over time, making professional property management a wise investment in itself. This partnership is key to long-term profitability. Exit strategies and market timing. Developing a clear exit strategy is as important as the initial investment decision in international real estate. An exit strategy outlines how and when an investor plans to sell their property to realize profits or minimize losses. Common exit strategies include selling to another investor, selling to an owner-occupier, or divesting through a real estate fund. The chosen strategy should align with the investor's financial goals, risk tolerance, and the expected market conditions at the time of sale. Factors such as capital gains taxes, repatriation restrictions, and market liquidity will heavily influence the feasibility and profitability of an exit. Planning for these eventualities from the outset is crucial. A well-defined exit plan provides a roadmap. Market timing plays a pivotal role in maximizing returns from an international real estate investment. Selling at the peak of a market cycle can yield substantial profits, while selling during a downturn might necessitate accepting losses. However, accurately predicting market peaks and troughs is notoriously difficult. Investors should monitor key economic indicators, local market trends, and geopolitical developments for signs of shifts in supply and demand. Flexibility in the exit timeline is often beneficial, allowing investors to hold properties longer if market conditions are unfavorable, or accelerate sales if opportunities arise. Engaging local real estate agents and market analysts can provide valuable insights into optimal timing. Ultimately, a pragmatic approach that balances market conditions with personal financial objectives is key to a successful exit. Patience and adaptability are virtues in this domain. Emerging markets versus developed markets. The choice between investing in emerging markets and developed markets is a fundamental decision in international real estate, each offering distinct risk-reward profiles. Developed markets, such as those in North America, Western Europe, and parts of Asia, typically offer greater stability, transparent legal systems, mature infrastructure, and predictable returns. They are characterized by lower volatility and established property rights, making them attractive for conservative investors seeking steady income and capital preservation. However, growth potential might be more moderate, and property values are often higher, leading to lower yields. These markets are generally more liquid, allowing for easier entry and exit. They provide a sense of security and reliability. Emerging markets, found in regions like Southeast Asia, Latin America, and parts of Africa, present higher growth potential driven by rapid urbanization, demographic expansion, and economic development. These markets can offer significantly higher yields and greater capital appreciation opportunities due to lower entry costs and faster economic expansion. However, they come with elevated risks, including political instability, less transparent legal frameworks, currency volatility, and infrastructure deficiencies. Liquidity can also be lower, making it harder to sell properties quickly. Investors in emerging markets often require a higher risk tolerance and a longer investment horizon. Thorough due diligence and local expertise are even more critical in these dynamic and less predictable environments. The potential rewards often justify the increased scrutiny. Impact of global events on real estate. Global events ranging from economic crises to pandemics and geopolitical conflicts can have profound and often unpredictable impacts on international real estate markets. Economic downturns, such as the 2008 financial crisis, can lead to widespread property value depreciation, increased foreclosures, and reduced investment activity across multiple countries. Pandemics, like COVID-19, can disrupt supply chains, alter consumer behavior, and shift demand for certain property types, such as a decline in office space demand and a surge in logistics properties. Geopolitical conflicts can deter foreign investment, increase political risk, and even lead to physical damage of assets in affected regions. These events underscore the interconnectedness of global markets. Understanding these ripple effects is crucial. Investors must adopt a resilient and adaptable approach to navigate the uncertainties posed by global events. Diversification across geographies and property types can help mitigate the impact of localized crises. Monitoring international news, economic forecasts, and expert analyses is essential for anticipating potential disruptions. Scenario planning, which involves considering various outcomes and preparing contingency plans, can enhance an investor's ability to respond effectively. The ability to pivot investment strategies, such as shifting focus from one market to another or reevaluating asset classes, is also vital. While global events are often beyond an individual investor's control, proactive risk management and strategic flexibility can significantly reduce their adverse effects. This preparedness is a key differentiator for success. Sustainable and green real estate is an increasingly important trend in international markets, driven by environmental concerns, regulatory pressures, and growing investor demand for socially responsible assets. Green buildings are designed, constructed, and operated to minimize their environmental footprint, often incorporating features like energy-efficient systems, renewable energy sources, water conservation technologies, and sustainable materials. These properties typically offer lower operating costs, reduced carbon emissions, and improved indoor air quality, making them attractive to tenants and buyers. Investors are recognizing the long-term value creation and risk mitigation associated with sustainable properties. This focus on sustainability is not just ethical, but also financially prudent. It reflects a shift in global priorities. Investing in sustainable real estate can offer several benefits, including enhanced property value, higher occupancy rates, and access to green financing options. Many jurisdictions now offer incentives such as tax breaks or expedited permitting for green developments. Furthermore, properties with strong environmental, social, and governance (ESG) credentials are often more resilient to future regulatory changes and climate-related risks. However, the initial construction or retrofitting costs for green features can be higher, requiring careful cost-benefit analysis. Due diligence for sustainable properties includes assessing certifications, for example, LEED, BREEAM, energy performance data, and the availability of green technologies. As global awareness of climate change grows, demand for sustainable real estate is expected to continue its upward trajectory. This sector presents significant opportunities for forward-thinking investors. Technology's role in international investing. Technology is rapidly transforming the landscape of international real estate investment, offering unprecedented tools for market analysis, property management, and transaction efficiency. PropTech, property technology innovations, such as artificial intelligence, AI, and machine learning, enable investors to process vast amounts of data to identify market trends, predict property values, and assess risks with greater accuracy. Virtual reality, VR, and augmented reality, AR, are revolutionizing property viewings, allowing investors to tour properties remotely, regardless of geographical location. Blockchain technology is emerging as a potential game changer for secure, transparent, and efficient property transactions, reducing the need for intermediaries. These advancements streamline the entire investment lifecycle. They enhance decision-making capabilities significantly. Digital platforms and online marketplaces have democratized access to international real estate opportunities, connecting investors with properties and local partners worldwide. Data analytics tools provide real-time market insights, helping investors make more informed decisions about entry and exit points. Smart building technologies optimize operational efficiency, reduce energy consumption, and enhance tenant experiences, adding value to properties. Communication and collaboration tools facilitate seamless interaction with local advisors and property managers across different time zones. While technology offers immense benefits, investors must also be aware of cybersecurity risks and ensure the reliability of digital platforms. Embracing these technological advancements is crucial for maintaining a competitive edge in the evolving international real estate market. It's a vital component of modern investing. Key takeaways and best practices. Investing in international real estate offers significant opportunities for diversification, capital appreciation, and income generation, but it demands a disciplined and informed approach. The key takeaways from this course emphasize the importance of thorough due diligence, understanding local market dynamics, and mitigating inherent risks. Successful international investors prioritize comprehensive research into economic indicators, political stability, and legal frameworks before committing capital. They recognize that what works in one market may not apply to another, necessitating a tailored strategy for each investment. Embracing a long-term perspective and being prepared for market fluctuations are also crucial for navigating global real estate cycles. These foundational principles guide sound decision-making. Best practices for international real estate investment include building a strong network of local partners and professional advisors, such as lawyers, tax consultants, and property managers. These experts provide invaluable on-the-ground insights and ensure compliance with local regulations. Diversifying investments across different geographies and property types helps spread risk and enhance portfolio resilience. Developing clear financing and exit strategies from the outset provides a roadmap for capital deployment and realization. Finally, staying abreast of global events and technological advancements is essential for adapting to evolving market conditions. By adhering to these best practices, investors can enhance their chances of achieving successful and profitable international real estate ventures. Continuous learning and adaptation are vital. Future outlook for international real estate. The future of international real estate investment is poised for continued evolution, driven by demographic shifts, technological advancements, and a growing emphasis on sustainability. Urbanization trends, particularly in emerging markets, will continue to fuel demand for both residential and commercial properties. The rise of remote work and flexible office models may reshape demand for traditional office spaces, while logistics and data centers are expected to see sustained growth. Climate change and resource scarcity will accelerate the adoption of green building practices and sustainable investment criteria, influencing property values and development decisions. Investors must remain agile and forward-thinking to capitalize on these evolving trends. Anticipating these shifts is crucial for strategic positioning. Technological innovations, especially in PropTech, will further enhance market transparency, streamline transactions, and provide more sophisticated tools for analysis and management. Blockchain could revolutionize property ownership records and transaction security. The increasing availability of data will empower investors with deeper insights, enabling more precise market timing and risk assessment. Geopolitical shifts and global economic rebalancing will continue to create new opportunities and challenges, requiring investors to stay informed and adaptable. The long-term outlook suggests a dynamic and interconnected global real estate market where informed, strategic, and ethically conscious investors are best positioned for success. Continuous adaptation and learning will be paramount for navigating this future landscape.